Hey Singapore investors, it's Iggy from the Investing Iguana. If Keppel DC REIT has been sitting on your watch list and you're wondering why Maybank just put a buy tag on it with a target of $2.40, you're in the right place. I'm breaking down that report line by line, translating the analyst jargon into plain English, and adding my own take so you can decide whether this data center specialist deserves a spot in your CPF or SRS portfolio. First, the numbers. Keppel DC REIT's first quarter 2025 update showed gross revenue of about 102 million Singapore dollars, up 23% from a year ago. Net property income came in at 88 million, up 24%. Distributable income soared 59% to roughly 62 million, and the distribution per unit rose 14% to 2.503 cents. Portfolio occupancy held steady at 96.5%. The trust's leverage sits at 30.2%, giving it room to borrow for future deals, and the interest coverage ratio is a healthy 5.8 times. Why is revenue growing that quickly? Management added 3 hyperscale data centers, 2 in Singapore, 1 in Tokyo, late last year. Those assets kicked in a full quarter of rent for the first time, and rent escalations from existing tenants added an extra lift. Even with no major leases up for renewal in the quarter, Keppel DC chalked up positive rental reversions of about 7%. Now zoom out to the industry. Data generation is compounding so fast that global demand for server space is expected to expand at roughly 17 to 19% a year between 2024 and 2028. Singapore's own data center market, already worth roughly 4.16 billion US dollars, is projected to reach 5.6 billion by 2030, despite a cap on new supply. Remember the moratorium that froze new builds here back in 2019? It ended in 2022, but the government replaced it with tight energy use rules that still limit how many new megawatts can come online. Less supply plus exploding demand equals pricing power for existing operators, especially those like Keppel DC that already control strategic sites connected to the national fiber backbone. Competition is heating up. NTT DC REIT, which listed on the Singapore Exchange on the 14th of July, offers a headline yield of 7.5%. Sounds tempting until you see that a single tenant provides nearly a third of NTT's rental income. Its weighted average lease expiry is under 5 years, and gearing is already north of 35%. Keppel DC, by contrast, spreads risk across 24 facilities in 10 countries and boasts a lease expiry of slightly over 7 years. Hyperscale clients now contribute about 63% of rent. High. But these are the very customers driving AI workloads that need 4 to 10 times the power of legacy cloud traffic. Let's talk valuation. Keppel DC units changed hands recently in the low $2.30 range. On that price, last year's full-year distribution of 9.451 cents translates into a trailing yield of a little above 4%. Analysts expect DPU to grow around 5% a year, putting forward yield near 4.25%. The trust trades at roughly 1.44 times book value, which is expensive versus industrial or retail REITs, but normal for specialized data center landlords. Maybank's $2.40 target is actually conservative compared with the market-wide consensus of about $2.46. If you assume that figure and a current price near $2.29, you're looking at upside of roughly 7%. Before dividends. Risks? Higher electricity and carbon costs could squeeze margins, although many of Keppel DC's leases pass power expenses through to tenants. Rising interest rates are another worry, but almost 70% of its debt is fixed, and the average cost of borrowing is roughly 3.1%. Foreign exchange swings matter because 1/3 of rent is collected in euros, pounds, or yen, but most of that currency exposure is hedged. Finally, heavy reliance on hyperscale users means the trust must keep those clients happy with continuous upgrades. Bigger power draws, liquid cooling, you name it. That requires capex, but the low gearing ratio leaves room to spend. So, do I back Maybank's buy? Yes. The analyst nails the structural growth story yet still plays it safe on upside. Where I go further is on rent repricing. About 15% of Keppel DC's leases in Singapore expire this year, and management is hinting at rental reversions north of 30% when those contracts reset. That figure alone could push DPU growth beyond the 5% pace analyst model. I see the trust as an attractive long-term compounder, ideal for the income sleeve of your CPF ordinary account or the growth and yield mix you want in SRS. Here's how I'd play it. If you already hold the units, sit tight and drip the dividends back into more units via CPF top-ups or cash. If you're new to the name, consider building a starter position at current levels, then add on any pullback to the $2.20 handle. Your primary catalyst over the next 12 months will be the July 25th half-year results, where management is expected to confirm the next jump in distribution. Before we wrap, a quick word on what you get by joining our premium tier. Members receive videos like this up to a week early, along with my rapid-fire notes whenever markets twitch. Think of it as an extra set of eyes on your portfolio for about $1 a month. If that sounds useful, the link is in the description. That's it for today's deep dive on Keppel DC REIT. Smash the like button if you learned something, share the video with friends who park savings in REITs, and tap subscribe so you never miss an update. If you want a refresher on valuation metrics like price to book and dividend yield, my explainer video is also linked below. This is Iggy, signing off until the next investing adventure.